and welcome to yet another episode on our channel Talk of Town. We are here under the series Beyond Boundaries, discussing with subject matter experts. This is an episode on personal finance in continuation to our episodes in the previous months. As usual, I have two gentlemen with me, Mr. Prabhanjan Rao, founder, Elysian Advisery, a SEBI registered investment advisor, providing a lot of personal financial planning to non-resident Indians based out of Dubai and across the world. I also have with me Mr. Ashwin Kumar, the director of DAA Capital. He's also been in the markets for slightly over 1.5 decades now. So, hi, Ashwin, and hi, Prabhanjan.
Hi,
Hi,
hi, Prabhanjan ji.
hi, Ellen, and hi,
How
Ashwin.
is the Dubai weather? Like we spoke,
Wow,
so is it nearing the all-time highs as the markets are doing?
absolutely. I mean, looks like both Dubai weather and the stock markets are talking to each other. So the scorching, I mean, it is increasing at a scorching pace. And in fact, last Saturday or Sunday, the Abu Dhabi has recorded 51 degrees. Khalij Times
My
has
goodness
reported.
me. And I
So
think we're still in May. June, July is going to
yes,
be peak summer.
absolutely, and so as the markets, I hope. So I then as long as the markets are also rising, I don't mind this heat. Let me bear the heat.
Everything else can be digested.
Absolutely. And thanks for calling me. I mean, it's a wonderful to be part of you.
Great.
Yes, yes,
I
Lakshmi.
mean, ever since our previous discussion that we had, uh, you know, the lot of events that took place. Of course, we had a warish scenario here between India Pakistan. We did have a lot of information coming in from the US. We also had the Fed meeting. So, I mean, I would first start off with Prabhanjan ji as usual. So, your thoughts on the sequence of events that panned out over the last 4 to 6 weeks. Over to you.
Okay, thanks, Ellen. And of course, I mean, a lot of interesting events that has panned out in the last 2 to 3 weeks. And especially the most, I don't know whether I can call it an unexpected or an unexpected one, the Indo-Pak. It is not less than a war, what we have seen. And, but fortunately, the Indo-Pak worries has been fading over the past, like last 1 week. And of course, I mean, the Trump 90-day pause on the tariffs, and lots of countries are being, they have come to negotiate with Mr. Trump. So that's one good news, and also markets have been reacting to that. Similarly, we can't forget that India has become the fourth largest economy, surpassing Japan. So,
Japan.
congratulations and kudos to everyone. And of course, the other little micro factors are like dollar indexing coming less than 99. The Brent crude, at 65. Moody has downgraded US credit rating. That has also has impacted. I don't know whether to say positively or negatively, but it is good for the Asian markets. So to sum it up, these are the things which has giving a directions to our market. So we can discuss that in detail at a at a later stage.
Great, as usual, wonderful, good start to this episode. Ashwin, your thoughts on the series of events for the last 4 to 6 weeks?
Look, Ellen, the when we were growing up with the markets, like you said, we've been in the markets over a decade and a half. So when we were growing up in the markets, one thing that was kind of uh, we were taught about very seriously was that markets always climax on the back of either extremely good news or on extremely bad news. And last 30 to 45 days has been a witness to that. So
Right.
we had, I think, if I just take the recent charts, Trump tariff news was the day when we made the bottom in the recent past, and then ever since that we have been rising. Of course, the India Pakistan war did not really actually move the markets by more than 2 or 3%, and we have recovered ever since the announcement of ceasefire. The markets have done really well. But what is interesting to see and what is kind of validating our thought, because I always try and keep a tab of what we spoke over the last sessions, and then are we keeping in line with it? Because at the end of the day, there is always going to be a takeaway that our viewers are going to have at the end of no, this session, or whatever we are calling as so-called experts talking or giving the opinion. They have to have a takeaway and be able to implement that in the market. So if you recollect, we were talking about how the market is going to move up, and how it is going to be a very selective set of stocks or sectors that are going to move the market, and that's exactly how the market has panned out. May not, we could possibly have not predicted the events or the timings that are going to drive it, but at least going by the charts, because as you understand, I'm purely talking here from a technical point of view. That's what the charts, the charts indicated an interim bottom about 30 to 45 days back, and the markets have fairly come up. I think we are just not too far away from other life, probably another 1,200 points, which is approximately 4.5% from the all-time high. But the interesting part is it's only a few selective stocks that have moved the market. So when you go back to your portfolio and analyze it, while the index has made a big shift, the portfolios may not necessarily have made this uptick. So as investors, I think we need to be very selective in the stocks that we're going to build our portfolio with, and this is the kind of surprise or ambush that we need to understand and acknowledge that the market is going to do. So even if the market moves to 28, 29, 30K, the Nifty, we may not really have the portfolios moving the same way. So that's something I'm very curious and interested to see. And I think that's where we as fund managers, do play a, or rather I would say this is a challenging time for even a fund manager. This is where you, end up proving your mettle as a fund manager. So interesting times ahead. So, but markets have done really well. So every time, I just recollected the last two times that we had this session, two or three times, we were always coming on the back of really bad market scenario, but at least this time around we are doing really well. So I'm happy about it.
Excellent, excellent. So Prabhanjan, historically we've been taught that buy when it is attractive, sell when it is overvalued. Theoretically, all of us understand. Many of us, come across this philosophy frequently, but when it comes to practice, somewhere we tend to fail. If you look at the statistics, over the last say 6-8 months, a lot of people have discontinued their SIPs. A lot of people have pulled their money out of the market, be it equity or mutual funds, owing to the volatility that we've seen in the markets. And now, after markets have recovered, they're coming back, restarting their investments. Your thoughts on this?
Absolutely. I think what Ashwin made a point is very valid. Though the index are reaching their top heights, the individual portfolios, yes, they have recovered. They have made all the losses. I don't say all the losses, but majority of the losses they made good. But it is not reaching the heights which we saw it 6 months back. Still, some of the mid cap and the small cap portfolios, stocks, are still less than 25 to 30% from their recent heights. And it's again a stock specific approach. It's again a stock selected focus that has been taken. So, as he rightly mentioned, as fund managers, we need to be extra cautious. So, coming back to your question of the markets, how we are going to flare in the coming months is, see, of late, what has happened is, there are a lot of global events that has been having an impounding impact on the Indian markets as well. So when we say global events, one or the other thing that keeps happening, either it can be from the US, it can be from the Ukraine, Russia, or it can be from the China, or it can be from the India Park, or from the the recent the Houthis again. They have invaded. With missiles on. So, having regard to those global events, the markets is not able to take a proper shape, right? So, in that context, we need to be extra cautious on how we make the portfolios, and uh, and also, like, recently the Moody has downgraded the US credit rating, and it has got a long lasting impact on it, because if we see, to me, the rating agencies are absolutely and largely irrelevant, because whatever rating agencies downgrade the US market, um, it doesn't have much impact in the longer term. It may have a shorter term impact, but longer term it doesn't have any impact. US still, it has got an exorbitant weightage on the currencies. And we still, of course, every country still feels that US dollar as a safe currency. Despite US adding to a great 6.4% deficit to that, right? So we having regard to those things. And also, when the Trump again is poking on, what do you call it, as the tariffs. So markets, are getting into a jittery mode, somewhere or the other. You see we I mean, some point we see that markets are taking a bottom, but still it doesn't take a bottom, and then again it rebounds and then takes its own way. So these things has to, and I'm sure, I'm not saying that these things will uh, can be stopped going forward. No, it will keep continuing. But as portfolio managers, we need to be very cautious on which sectors or all this, these things have an impact. And then we have to make a lot of rejig. And in fact, we also made a lot of rejig in our portfolios. We made a lot of rebalancing in our portfolios,
Okay.
and also did a lot of tax harvesting. And that's where I think we should. That is the key to go in making the portfolios positive.
Excellent, sir. Excellent. Well, I'll come back to you on the sectors that we need to keep a watch. I would like to put Ashwin on a spot. So, where do you think markets are heading after such a rally over a shorter period of time? Do you foresee that we've seen the bottom, or the story is still not over?
Look, LNC, at any point in time of the day or night, you ask me the one question that I always, this one question, I always, reply with the same answer, that the market is a random walk theory. At any point in time, there's a 50% chance of market coming down vis-a-vis the market going up. So while I can give you a lot of inputs and indications of, technically the Elliott waves are showing wave 4 down, wave 5, all fancy numbers, none of us actually know what the market is going to do.
Absolutely.
But to answer it in a different context, we are still not 100% deployed. We're still sitting on a double-digit cash, and whether this can be directly correlated with the market bottoming out or not, I don't know. But the reason we are still sitting on cash is because we've still not identified or come across stocks wherein we can completely deploy our money into, and it's just an opportunity fund we are holding back. And I'm not too glowing. I'm not too glowing with that the market or the charts indicating a new all-time high anytime soon. So see, and technically speaking, if you recollect, Ellen, the other day we were talking about the charts, and sometimes even though the market makes a new all-time high, it can also be termed as a corrective rise only to fall further down. So many factors are there, so many technical and fundamental factors are there. So at this point in time, I'm still holding double-digit cash in the account just because we have not found the right set of opportunities. I do understand that in the recent 30 to 45 days rally in the market, a specific set of stocks have gone up. We too have invested in them, come out of it, but that is more of a speculative bet, but not really a long-term bets.
Okay, interesting. So double digit percentage of portfolio in cash is quite interesting. So, Mr. Prabhanjan, coming back to you, which are the sectors that we need to keep in mind? Maybe Ashwin would be able to deploy the idle cash that he's holding.
Well,
I would love to,
if,
and this coming from an SEBI-registered RIA, it will have more validation.
before I directly delve into the question, I would like to give some more meat on the bone. Why India is a sweet spot? Because when we say investing across the world, why someone has to select India? Because that can also be a sector, and that can also be a market. Why India is a sweet spot? See, of late, India has reached the 4.2 trillion dollar economy, surpassing Japan, and it has taken it will take just 2 to 3 years to surpass Germany with the kind of growth what we had. So Germany at present is 4.7 and India at 4.2. So zero point 0.5 trillion, I think it will hardly take not less than 2 to 2.5 years. Now I will also give a bit of a statistics why India is such a sweet spot. If we see the GDP growth in the last 10 years, the world's largest economy, US, has grown 66% CAGR. China, it has grown by about 76%. Germany, about 43%.
Last 10 years, is it?
Last 10 years GDP growth. So Japan, negative growth of minus 1.3%. And look at India, it is 103%. And if we see India and China, the GDP is in terms of like it will take a lot, maybe a decade to reach China's GDP. But however, see the growth at what we are growing. If China is growing at 75.8% in the last 10 years, we have grown at 103%. So at this scorching pace, India is such a sweet spot of why we should remain invested in India. Now coming to the question, within India, which are the sectors which are like has to be invested? As I said, we need as fund managers, it is too difficult for us to pinpoint and then say which sector is where we can make money, because 6 months we bet on one sector and then immediately because of the global economic factors, that sectors loses the flair and then some other sectors will come into picture. And there are a lot of other macro factors like MSI rejig. I'm sure on by the end of this month there is a small MSI rejig on the small and the mid cap sector is happening. I can see a lot of portfolios, some of the stocks in the portfolios, they are increasing about 4 to 5%. Right, so those things are happening, and as always, to be from Elysian, we always believe in secular growth sector.
Okay.
To be more specific, in under secular growth sector, we believe in banking and finance sector, NBFC stocks, because irrespective of whatever happens, and Indian the NBFC sector or the banks are rightly poised at this stage, and we believe that should be the first sector where we need to put our money.
Okay.
The second sector, what I also believe, is because of these trade negotiations, the textile sector has become more, textile and the chemical sector has become more. So China 1+1 strategy might also play it here. So the textiles and the chemical sector can also be one of the sector which we can look into. Apart from these three, the IT sector. Since
Right.
last 3 years, we have been talking about IT sector, but barring it, there is no issues on the growth perspective, growth per se for these IT stocks, but it is the euphoria that is making these IT stocks, not outperform. As and when we see interest rate cuts, both of course India is seeing the interest rate cuts, even in US. And I think now what is happening is even in the US, Mr. There is your words against my words. That has been the talk between Mr. Powell and Mr. Trump. I think those things will take time to fade out, and then when the US starts reducing the interest rate cuts, the inflation is worries, then the IT sector is the one which will be the flavor once again. So the banking, the IT sector, the textiles, the chemical sector,
Yes.
and automobiles, not the least. These are the sector where, of course, many of the automobile export hub is US and Europe, and I'm seeing more than Europe can see a bigger growth in the coming next 3 to 5 years. So when the Europe rebounds, and we can see those things even in the Tata Motors, the has already started clearing. Again, disclaimer: we have advised these stocks to our clients. Um,
Okay.
so, the automobile sector is also one sector which we see a lot of value. There has been 30% down in the last 6 months, but some of the stocks in the mid cap and the small caps has rebounded. So, and yet, in the automobile sector, we are not that, going gongo on the EV sector for now. because of lot of global factors. So we are waiting for all the other factors to fade in before we again look on the EV sector. So
Okay.
this is broadly where we are invested in.
Interesting. When you mentioned auto sector, mid and small caps, do you also include auto ancillary?
Ancillaries, yes, yes, auto and auto ancillaries.
Okay, okay, okay. Okay, great. I mean, now that we got some insights on what sectors that we need to look at, Ashwin, my question to you is, from a when you look at it from a asset allocation point of view, coming back to your point of holding cash in double digits. So a lot of people are in a hurry to buy gold and silver. So, what your thoughts on this?
I think, Lakshmi, we all have to acknowledge one fact that if you have missed the gold rally, we have missed it. And let's not get into the FOMO effect. It has rallied quite a bit, and let it cool off for now. It's not, I'm not saying it's topped out and you should start exiting it, but if somebody in a typical traffic light signal, I think we are looking at gold in an amber zone or into the slowdown phase. It might turn back to green or it may come to red, but at this point in time, I'm not looking or suggesting any further top up or new investment. So somebody who has invested earlier can start looking to offload or cash out some of the profits that they have made in gold, but no new investments at this point in time,
Okay, okay.
Yeah.
So,
unless somebody is really looking at have a very bearish view on the stocks and they're looking to hedge their portfolio, which I'm pretty sure most of us already have 10 to 15% of commodity exposure, both silver and gold, but no new investments at this point in time. While if I have to be really bullish of the both, I think I would be a little more towards inclined towards silver, but nothing, no new fresh investments right now.
okay. So, if somebody is investing in gold and silver on a sequential basis, regular basis, they can continue to do.
Just like the market SIPs, I think it should continue as is.
Okay, great, great. Mr. Prabhanjan, another interesting discussion which I wanted to have with you is when you specified about having an eye on sectors which are going to do well, and probably, you also mentioned that once in a while we need to kind of rejig the portfolio, because of maybe global news coming in. Always there's a feeling that while we invest in sector A, unfortunately, sector B looks lucrative, and when we're investing in sector C, sector D looks more lucrative. So, how do we look at this particular, way of investing? Because none of us can avoid it. Most of us go through this FOMO effect, even when we are looking at sector-specific investments. So, how do we deal with this scenario?
Right. If you can allow me, I just wanted to touch upon one aspect which Ashwin was talking about on the
Sure,
commodities.
please.
Well, I think I agree with what Ashwin has said, and I also want to point out one here is apart from gold and silver, there's one more thing that is coming up is the copper. So the copper is one where I think I've been reading some articles and also attending some lot of seminars on the copper, and then making some research on that. See, if we dig deeper, and then where the copper is being used, and what is the supply, and where is the demand come from the copper. The supply of the copper is limited, but the demand at which it is growing more than the supply is getting into the EV segment. Not only in
Okay.
the EV segment, it is also getting into the defense segment. So when the entire world is racing in the defense and also in the EV is growing, I think copper is one area where we may have to look when someone wants to invest in the commodity. In the next 10 year, I feel copper is where it might take a better shape. So coming back to your the question, like
I mean, just to
yeah.
stop you there, I mean, how does one invest in copper as an individual investor, being a resident Indian? Any avenues available today?
I mean, good
Would you like to
question.
stocks? Trade
Yes,
with copper?
absolutely. So see, on the commodities front, investing into copper, or it's again, how do we invest in the commodities? Is where it takes the same shape. You invest. I mean, how do you trade or the invest in the crude? The sugar, the other currencies. So again, it takes the same thing. But however, to answer your question, if you are outside India, it becomes more easier to invest in those things. But as a resident Indian, there are limited options to invest in the commodities.
Yeah. Yeah.
Right.
Please go
So,
ahead.
yeah. So, to answer back your question, how many times we may have to rejig? If we rejig the portfolio, I mean, maybe the one which we have sold, it starts performing. So that is a chicken and egg story. So, I mean, I've been in this, and so many stocks I have sold. Believe me, Ellen, the moment I sell the stocks, it starts increasing. So I have never understood why. So I think we should just get out of that behavior, and
Maybe
then
I should
there is
start buying them as you exit.
exactly. So this is a chicken and egg story that never it's a continuing story. We can't avoid it. And can we invest in all the stocks? I would say no, because the moment you diversify into every sector, then you will not create wealth. Yes, you will be safeguarded, but wealth creation happens when you concentrate. If you have less than maximum 5 to 10 stocks in your portfolio, then the wealth creation can happen. But if you try to diversify in every sector, it's again you can't create wealth. So it's again the conviction, it's again the statistics, it's again how the macro and the microeconomic factors that plays. It's what and again in the short term, where is that is the stock, but is the flare of the market. There are so many stocks, plethora of stocks in the Indian market, where they are good value stocks, but it is not the flare of the hour at all. So the stocks are not increasing. So, but still, one or two stocks we have to remain invested in such stocks, irrespective of the sector, and where we can see some. There will always be a what do you call it, as a churning of the money. Investors always look for value stocks. So in such case, I always keep saying that when we keep our investing target as a business plan for 5 to 7 years, so that is where even the sector, one sector, if that doesn't perform in 3 years, from the fourth year it will definitely start performing. That is what we have seen in the last 15, 18 years.
Yeah.
So and if we see 5 to 7 years or 10 years as a business plan, we can clock a CAGR of more than 15% tax rate, and that is a decent ask.
Okay. I mean, the rule of Pareto applies here, right? So 80% of the wealth is made during 20% of the time. That means
Absolutely,
80% of the time we still need to stay invested to make money.
absolutely.
Yeah. I mean, excellent insights today. I'll leave our audience to kind of do their homework on these 4 5 sectors that we discussed today, and probably scout for good stocks. And we are not letting the audience go anywhere, because we'll be continuing the series of discussions, many more interesting topics coming your way very soon. Until then, stay tuned, subscribe to our channel, share this video to your contacts, and see you soon.
Thanks,
Thank you.
Ellen. Bye.
Thank you. Bye bye.